Good day, everyone, and welcome to our latest video report. I'm Dion Zakuski, Branch Manager, Senior Wealth Advisor, and Portfolio Manager with you. And as we get close to this halfway point of 2024, we'll look at how markets have performed year to date, why Canada has started to cut interest rates, but the US won't for now, along with some strategy notes. Finally, we'll bring in our associate Rachel, who is going to discuss the upcoming capital gains tax changes. Now, with the warmer weather finally here, we've been getting asked if investment markets will also stay hot. There was a hot streak for about 4 or 5 months starting before the new year. We saw a dip down in April, and now another rise higher. At the time of recording here in mid-June, the Canadian TSX market has advanced about 5% year to date, while American indexes have been pushing into the double digits. To see how these two indexes compare to each other, let's check out the following chart. What we're looking at here is the US S&P 500 market versus our Canadian TSX, and how they've been performing relative to each other going all the way back to the 1950s. It was a relatively even scorecard. However, in the past 10 to 12 years, as we look to the right of the chart, the US market has definitely been the place to be. And our models here at the Zakuski Group have been reflecting that, having more investments on the US side than Canadian. Now, related as to why the US market has been outperforming Canada has to do with the overall strength of the economy. We could present the case that the American consumer has had a powerful effect on this. They have a tighter labor market down south. We have poor government economic policy here in Canada, and so on. But this all combines for relative strength in the United States, which takes us to interest rates. Just recently, our Bank of Canada has reduced interest rates by 25 points, its first cut in the last 4 years. There may be more on the way as our economy needs a boost to avoid recession, but maintain a careful balance to not overshoot housing prices higher again. In the United States, inflation is staying sticky. They have a full labor market and strong consumer spending, so there really isn't a need for them to cut interest rates at this time. As a result, we've seen some temporary market choppiness whenever the US Federal Reserve has mentioned these obvious points, and then markets seem to go higher within the next couple weeks. This tune is quite different from the start of the year, when it was predicted that we would see multiple interest rate cuts south of the border. And what we're looking at here is a chart from our strategist here at Scotia, looking at where we were at the beginning of the year when it was predicted that there would be up to 7 different interest rate cuts in the States. However, due to their strong economy, that has now been brought down to about 1 interest rate cut predicted for 2024, and likely 1 or 2 more into the new year. And this brings me to strategy. So why is this all important? Well, the US is still the world's largest economy, and their central bank policy has a direct impact on investment markets. If most of our equity positions are in the US, then it's obviously important for us to monitor this. Which brings us to positioning. Here at the Zakuski Group, we would agree with our Scotia strategists that being invested more on the growth side of things as opposed to defense will benefit investors going into the second half of the year. From a big picture point of view, economies are doing well, and corporate earnings show no real reason for a market downturn. The first half of the year saw accounts move fast like an Oilers McDavid rush going up the ice. And this will be hard to sustain, however, we are staying positive with a move a little further down the lineup. So holding other asset classes like private equity, real estate, and bonds can help withstand any of those temporary market pullbacks and keep risk in check. As always, if you want to discuss your planning in more detail, give us a call anytime. Have a great summer. And here's Rachel with what you need to know on the upcoming tax changes.
Hello, I'm Rachel Collin, Investment Associate with the Zakuski Group. Today's topic for our Did You Know segment will be our government's capital gains tax changes effective June 25th, 2024. We can first discuss what a capital gain is. When you sell something and earn more for it than what you paid, that would be a simple capital gain. This can happen with portfolio investments like stocks, along with real estate. On the business side, you have capital gains with investments inside holding companies, real estate trusts, and overall business sales. Let's use an example where I show you what a taxable capital gain looks like on the sale of a pie on the personal side. So you paid $5 for a pie, and you sell it for $10. You would have a capital gain of $5. Of that $5, currently your capital gains are 50% taxable. So you would pay on $2.50 at your tax rate. The new rules are the same for personal gains until you earn over $250,000 in capital gains. Then each dollar after will now be taxable at 66% at your tax rate. With the new rules on the corporate side for holding company investment accounts, operating accounts, trusts, and business sales, the difference is that the 66% tax expense starts on the first dollar of the gain. It is important to reach out to your tax professional to see how these changes can affect you. To learn more on its impact to your wealth plan and investment strategy, we welcome you to contact us anytime here at the Zakuski Group. Thank you for watching and have a great summer.